All right, it's the day after Easter. I hope everyone had a great Easter. Some of you might think that I took the day off yesterday. I actually did record something. I was planning to post it up, but frankly, I was dissatisfied with it, and I didn't think that I really added anything, and I didn't want to waste your time with something that I didn't find to be that interesting and that I thought was kind of disjointed and didn't really get any points across. And so I'm actually going to do a do-over of what I discussed yesterday and hopefully be more articulate. Because, again, I don't do notes for these things. I don't plan them out. I just try and think through things in my head. And I'm thinking out loud. And sometimes my thoughts are coherent. Other times, I have to do a little more thinking for them to really take shape. And so when looking at and trying to reevaluate the future actions of the Federal Reserve, you always have to be looking at, because these are not consistent people. These are not people who tell you the truth. You have to constantly be reevaluating the situation, trying to analyze the current economic and political situation from the perspective of not just Jerome Powell, but the entire board, of the Federal Reserve, in order to try and forecast what they're going to do. Because what they plan on doing, obviously, is going to have a very significant effect on the daily lives of not just Americans, but people around the world, because the U.S. dollar is still, for now, the global reserve currency and the main medium of international exchange. So up until now, I have been making the case consistently that I think that the people at the Fed are more dovish than they even would lead us to believe. And I think that anyone who follows the Powell Fed, and really, the Fed going all the way back to 2008, arguably the Fed going all the way back to 86, anyone who follows them objectively would say that in general, the Fed is extremely dovish, that they are very much biased in favor of trying to treat financial markets with kid gloves, and to always make sure that stock prices and bond prices move in one direction and one direction alone. The Fed publicly likes to talk about its dual mandate, the dual mandate supposedly being low inflation and low unemployment. Whereas, those of us who make it a habit, for some ungodly reason, of following the Fed and watching their excruciating press conferences, and some people, I don't go this far, actually reading the minutes of their meetings, a lot of us would argue that the Fed's dual mandate is low interest rates and high asset prices, because that's effectively what they've been targeting for certainly the entirety of my life, but most notably in the wake of the 2008 financial crisis. But I don't want to speak like an absolutist. This can change. This can always change. The Fed very well might, in the near future, actually try and do something to stop inflation. They might actually put the goal of lowering inflation above rapidly increasing asset prices. I often talk like if there's a 0% chance that the Fed would ever risk asset price inflation in order to fight consumer price inflation. But something that we have to remember about the Fed is that they're not robots. It's not just that they have these two goals of high asset prices and low interest rates. They have a reason behind it. And the reason behind it, I think, is rooted in prestige and the enrichment of themselves and their peers. Everyone at the Fed is of sufficient means that they own substantial assets. And who benefits from high asset prices and low interest rates? It is, of course, people of means, people who own assets. And so, all else equal, it is in the Fed, the interest of everyone who is in a position of power at the Fed to increase asset prices. That is something that they like to see. However, these people at the Fed oftentimes are already absurdly wealthy before they even get to the Fed, before they get on the board at the Fed. And so it's not like they are merely using their position to enrich themselves. I think there are certainly ones who do that, but there are also people who are going to be rich either way. And I think Jerome Powell is one of them. If Jerome Powell left the Fed today, I don't think that he would be in a rough position financially. I think he would do just fine, all by himself. And so I think that the other thing that motivates people at the Fed, broadly speaking, is power and prestige. They like the idea of being, the American Politburo, because that is what the Fed is. That is how they operate. And so everyone they know, all of the people in the asset-owning classes, they come up to them, they look up to them, they hang on to their every word, they worship at the altar. And why do they do that, you ask? Well, it's because the people at the Fed are regarded as the financial wizards of smart who are there to ensure the everlasting prosperity of every single one of us. The people at the Fed, I think deep down, want to be loved. And so high inflation, which is something that the Fed itself claims, is one of the only two things that they exist to guard against. The other one, of course, being high unemployment. This high inflation is something that I think, even if only at a level of their ego, it hurts them. I don't think they're really being hurt financially. I don't think that they have necessarily a much pity for the common man. Otherwise, they wouldn't have been jacking up asset prices for all these years to begin with, and creating a housing crisis in this country. But nevertheless, I think the people at the Fed, they don't want to be looked down upon. They don't want people to doubt them. They don't want people to think that they're a failure. When asset prices are going up and we don't have, exceedingly high inflation, the Fed hears nothing but praise from all the people around them. And common people during times like that don't know the Fed exists. They don't think about the Fed. But at times like this, when we're in a period in which inflation is harming everyone in this country, when it is completely impossible to ignore the inflation that we're experiencing, then people start to think a little more and start to acknowledge and realize that, hey, there's this institution who is supposed to guard against this. And the obvious conclusion is that they are failing. And so this inflation is a threat to the legitimacy of the Fed itself. And if you know anything about people within the U.S. federal government, the deep state, the federal establishment, including people at the Fed, they're institutionalists who care more about the power of their agency than almost anything. They demand respect, and they have no tolerance for people who disrespect them. But the Fed is not like the FBI or the Department of Homeland Security or something like that. They don't have a police force. They can't go out and harass dissidents in the same way that the FBI does. So in that sense, the Fed's only recourse is to try and change people's minds by changing their own behavior. And ultimately that means actually fighting inflation, getting aggressive, raising by more than 0.25%. That doesn't mean that Powell's going to turn to Paul Volcker. It doesn't mean that we're going to get sufficient interest rate hikes. We're not going to, see the Fed really do what they need to do. But I think that it would be unwise at this point to assume as a base case that the Fed is just going to sit on their hands at this point and do nothing, while their credibility, which, again, in my eyes, the Fed was already completely uncredible. In the eyes of many people, the Fed has no credibility. But we're dissidents because we are not the mainstream. However, I think that even the Fed would start to fear that if this continues, they will lose prestige within the mainstream. Now, just as an example, I wouldn't take this too seriously at this point, and it is Bullard who I'm about to reference, and Bullard is one of the more unserious people at the Fed. He's not someone who you should assume ever represents the majority opinion of the Federal Reserve Board, but he's floating the idea that the Fed at some point might need to hike by 75 basis points, which is not a lot. It's not very extreme, but it is extreme by the standards of the Federal Reserve that we have known, at the very least, since Powell became its chairman. I honestly don't know when the last time there was a 75 basis point rate hike, but I would not be surprised if this would be the first one in over 20 years. But since it is Bullard who is talking about this, we wouldn't expect this at this meeting, at the next meeting. The Fed would not raise by 75 basis points. But if Bullard is talking about a 75 basis point rate hike, well, then a 50 basis point rate hike would probably be very much within the mainstream of Federal Reserve Board opinion. In other words, by Bullard bringing up the 75 basis point rate hike, that shows you that it is within the Overton window. And so if we have, a 75 basis point rate hike and a 0%, and a 0 basis point hike at opposite ends of the Overton window, and maybe a 0% rate isn't even in the Overton window now. Maybe it's only 25. Maybe it ranges between 25 and 75. That puts 50 right in the middle. Just a few months ago, even when we knew that inflation was happening, it would have been quite provocative, let's say, to claim that the Fed was going to be hiking rates by 50 basis points. Any rate hikes at all would have been quite controversial, because that's just not something that this Fed does. And it, like I've said so many times back in 2018, 4 years ago now, at the end of 2018, beginning of 2019, Powell pretty much closed the door on hiking rates, and he said to himself, and he said really to America, to the world, that he was going to do whatever it takes, which is actually a line I'm borrowing from Mario Draghi. But again, Draghi's whatever it takes line came right around the same time that Powell ended balance sheet runoff and pretty much ruled out any future rate hikes. But remember, back then, inflation was still contained to asset prices. It had not migrated yet into consumer goods. And so, what was going on with the Fed really was completely flying under the radar of the average American. So what does all this mean at this point? If I had to summarize one, the Fed might be serious about hiking rates this time. Again, that does not mean that they're going to be hiking rates as much as I'd like. Far from it. But they might not back down yet until the job is really done. And by the job getting done, I mean restoring their credibility as they see it. 2, stock prices likely have peaked. Real estate and bonds, it's less certain. Real estate's going to take a while to top because, as I've said before, it's an extremely slow-moving market. Here in Florida, year over year, we still are seeing reductions in inventory, in the housing market. And so it'll take a while for rate hikes to really cut into the buying power of the U.S. housing market. But in the meantime, we will likely see exchange-traded asset prices, which move much more quickly, start to plunge, and that in turn will severely affect the buying power of people in the housing market, because they will, they'll have a lower net worth. they will have less assets. And so a lot of people are going to find out, they're not as rich as they thought they were, and so maybe they can't afford a $500,000 house. Maybe they'll have to save more money because, for retirement, because their 401k, has lost, 15 to 20, maybe even 30% of its value. And when you factor in the supply side shocks from, Russian sanctions, and then now possibly sanctions on India and China, all of that makes the Fed's job more difficult because, inflation as a result of supply shock isn't even something that, the Fed controls. But the Fed will have to be that much more aggressive to clean up their own mess, of inflation that they created, because America will already be dealing with these supply shocks. An energy crisis can create a lot of price inflation on its own, obviously, because everything requires energy to be produced. And so if we have, monetary inflation, i.e. inflation fueled by the Fed, running rampant at the same time, it would be catastrophic. Catastrophic not just for the average American, but for the credibility of the Federal Reserve, who is supposedly tasked, being this apolitical, unelected Politburo, who is supposed to make sure that inflation is never a problem for America. And so I don't want to get too optimistic, but we may actually be moving into a relatively hawkish era in the history of the Powell Fed. Not hawkish at all by historical standards, not hawkish by my own standards, hawkish by Powell's standards. Because up until now, there have been no problems that the Fed has had to deal with, other than asset prices, which the Fed always claims was not a problem. They would always have to find excuses for propping up asset prices. But in reality, the Fed, didn't have any obvious problems on the surface that they had to deal with, and so they could focus all of their attention on propping up asset prices. But now, since inflation is front and center and has been for so long, they've been letting it go and saying it's not our fault, it's transitory, it'll go away, just don't think about it. Yet people are thinking about it now more than ever, and it refuses to go away. And so even if they are moving at a tortoise's pace, the direction is clear. The Overton window is shifting in a hawkish direction. So, with that said, I will see you folks back here tomorrow.